Let's start with that top line. The most bearish outlook on global growth since 2008. When was this survey conducted and what do you make of it?
So it was conducted last week. As you said, 200 fund managers globally representing almost $700 billion of assets under management. And the very clear headline takeaway is that investors are really bearish. They think the likelihood that global growth decelerates over the next 12 months is the highest since the financial crisis. It's not just about GDP. You've also seen the profit outlook darken considerably. So the highest portion of investors think that profits are going to decline since May of 2016.
So expectations look really toxic. The outlook for global growth, the outlook for profits, and the big concern that seems to be increasing over leverage as well. What do you make of that, Jared?
I think this is really the big story from the survey, one of the most important things we've seen this year. This is a big trend. You've seen increasing number of investors say, we've had enough buybacks, enough dividends, even enough capex. The big concern now is improving the quality of balance sheets. So more and more investors are telling us they want companies to improve, reduce their leverage. It's late cycle. It's time to get concerned about risks in the near future.
So what they say and what they do seems to be quite different. So I take all of these concerns and then I sort of try and correspond it, reconcile it with what is happening in fixed income. Leverage loans were solid last week, performed really, really well amidst the big drawdown in risk assets. How is that possible?
Well, it's a common scenario. Everyone is going to stay long until the market forces them to be otherwise. But what they're telling us from the survey is that as leverage has increased, U.S. credit to GDP is at 46%, all-time high. So everyone's alert to these risks, and until we see some kind of a market event really punish credit investors, we think they're going to continue to stay long.
Yeah.
What's important to take away from this is that the returns going forward as central banks are tightening, as global profits worsen, look worse and worse to us. That's why we've been short most of fixed income most of this year.
So some people would say last week tech stocks got absolutely battered. If this is the bias amongst fund managers right now, I want to take the other side, that this is a big contrarian buy signal.
Right.
Why is this not a big contrarian buy signal?
Well, cash levels are still really high. Investors are bearish. So the average cash balance was 5.1%. That's well above the long-term average of 4.5%. So it's not a big enough contrarian signal that you would get long the market. What it does suggest to us is that contrarians should look for regional pair trades. Investors are really short emerging markets in China. As a team, we've been long Chinese equities for a while in the view of Q4 fiscal stimulus. Short U.S. tech, still an overweight. We think that what we call Occupy Silicon Valley policies are only going to gain traction from here. And so as investors remain kind of positioned heavily in cash, heavily in growth, shunning EM and value, we think that's a great opportunity.
So you're looking for a convergence trade here, Jared?
Absolutely. If you look at the growth expectations for the U.S. versus the rest of the world, that divergence was actually the greatest since October 2007. So you're seeing record optimism about the U.S. versus the rest of the world. We don't think that's sustainable. Either the U.S. converges lower or the rest of the world gets some support on earnings.
China looks soft. So when people hear go long China versus a short pair trade against the United States, they're trying to make sense of that.
Yeah.
Can you walk me through that? What's going to be the policy response in China that is going to deliver your enthusiasm for Chinese equities?
Well, we've already seen, reserve ratio requirement cuts this year. We've seen, cuts on the monetary side. We've seen, support for even peer-to-peer lending. What we haven't seen yet is the really big fiscal push that would signal willingness of policymakers to unwind, some of the tightening on the fiscal side that they've done over the last year and a half. And it's very likely that trade tensions, as they continue to mount, as earnings pressure on corporates continue to decline, that China will feel compelled to act. And if that happens, we think that the upside for Chinese equities is extremely compelling.
I guess it's all relative to positioning, and month after month when I read this survey, the long Fang stock trade is the big overweight, very much a crowded position. Is it still there or is it starting to roll away a little bit, Jared?
It's still crowded, maybe a little less so this month, but for the 9th straight month we've seen investors tell us that long US Fang is the most crowded trade in the market today. We agree. We think it's a great short. We think the political and regulatory environment is extremely challenging. So even if it's not the biggest short of all time, the upside returns are capped.